Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I am the founder and host of the Intelligent Investor podcast, Stocktake, which is what you're listening to today. We have two guests today, one of whom is not Nick Cummings, who was due to come and talk about Virgin in the PE playbook. He's homesick, but we have instead a bevied up Graham Witcomb in Canada, where it's 8 p.m. He's had a couple of scotches, and he's going to talk about Woolworths. And we also
I've been writing about Endeavour, so very suitable.
And we also have a very hungry Gaurav who might nip off to get a carrot because he's got hunger pangs. Who will be talking about BHP. The two interesting companies who have been through some particular phases over the past few decades. We're going to kick things off with Woolworths and its lost decade. Graham, we had Woolies on our buy list almost continually for about 6 years from 2010. Let's say the returns were not stunning. They were pretty disappointing, especially as it was once deemed one of Australia's best businesses. Let's kick things off by explaining to us what went wrong at Woolies. How did they not manage to make money out of charging $50 a kilo for fresh ginger?
Yeah, it does look pretty bleak when you look at the share price. Our highest buy recommendation was at $36 or so in 2014. If you look at the stock now, it's about $31. So it definitely doesn't look all that good on the surface. It's a little better than that though, because it had the Endeavour spin-off. So that's added about $4 there. And then it also paid about $12 in dividends. So, but all up, it's still only a 3% a year return over 10 years, which is definitely below our average and not very good by any standard, especially with inflation being about 3%. So anyway, it was definitely a lost decade. But the reason, apart from the kind of spin-off and the payouts of profits, is pretty much that earnings per share just went nowhere for 10 years. I think the highest was around $2.10 or so in 2015. And right now, even if you adjust for Endeavour, it's barely $1.70 or so. So, yeah, that's a pretty bleak 10-year return for earnings per share. But unlike a lot of businesses, it wasn't because management did a bunch of crazy acquisitions and raised capital and blew the share count out.
Are you sure about that?
Yeah, it's mainly because the operations just didn't go to plan. And
right.
Yeah, the main one was Masters.
So let's just go through this then, because this is quite an important turning point in the history of this company. Bunnings was, as it is now, was just eating up the sort of the DIY market and making incredible margins. And Woolies wanted to compete with it. And Masters Home Improvement was the chain it set up in conjunction with US-based Lowe's to take them on. Why didn't that work?
It does seem like it should have worked a little bit, in that although Bunnings had this dominant and still has this dominant presence in Australia, like if you look at most other markets, it's at least a duopoly or an oligopoly for these sort of hardware businesses. So, I mean, I can empathize a little bit with Woolworths thinking, look, here's this near monopoly. We can take a bite out of that. They had plenty of resources behind them. They definitely gave it a go, opening, I can't remember how many, but dozens of stores. And yeah, it just didn't work. They were never able to get the efficiencies going to match the prices. So the Masters lost $250 million a year or so trying to match what Bunnings was able to achieve with its economies of scale. Mm-hmm. On top of that, there were some issues with Lowe's approach where they didn't really adapt for the Australian market. They didn't match the seasonal demand that Bunnings was, I guess, a lot better at. It seems kind of common sense now, and I'm sure that they put some thought into it, but for whatever reason,
these are Americans, the most
yeah,
on the planet.
I mean, Maybe there is something to that the Americans came in and they thought, why change something that works? It's just that in Australia, you can't match the same seasonal pricing and products that are used over in North America. Yeah. So, yeah, that was another factor. And, fast forward 5 years and Woolworths just, I think, gave up. They'd incurred so many losses. And part of me wonders whether if they had continued, they could have eventually chipped away. But I think time was running out for management. They just couldn't deal with these big operating losses every single year.
Yeah, so it was about 250 million a year. But do you think, looking back on it, even if they wore that for 4 or 5 years, do you think that would have been a good investment? Do you think they could have made it work? Or didn't they just didn't have the staying power to learn the lessons and do it well?
I do think staying power was part of it, that the investors and shareholders couldn't put up with that.
Couldn't stomach it.
Yeah, they didn't have a long enough mindset, I guess. They were looking at next year's earnings instead of 10 years out. I think that if they had stayed with it, they probably could have figured it out, but it would have, it's hard to measure how much return they'd get now because it's all imaginary. But given what Bunnings is able to achieve, then you would think that even if they took a reasonable market share, they could have achieved average returns. I would think they'd maybe always be the smaller fish in the market. But
that was my hot take as well. I reckon what happened.
We should point out to listeners, Gaurav, that you're a well-known DIY enthusiast, right?
Especially this week.
Yeah, especially this week. I'm the worst. I'm actually probably the only person in the country who doesn't like Bunnings, who loathes going there, and who's just puzzled by everyone's insistence to get a disgusting, wrinkly old hot dog. I don't understand this. I go long the stock and short the sausages any day of the week. I don't get it. I just don't get it.
I don't know. I'll defend Bunnings on this. I have fond memories of going there as a kid to the parking lot, getting a hot dog on some old bread.
Yeah, you're supporting the local netball club. Why wouldn't you want to do that?
Yeah.
I'd rather just give the money as a donation rather than have to be put through the ordeal of eating that disgusting sausage.
Anyway, let's get back to business. Masters blew up about $4 per share of value.
Yeah.
Gaurav
I reckon
thought it was
look, it's a good example of pressure being brought to management and management not having the stuff to withstand it. I actually think Graham's onto something there. I always felt as though that market is large enough to host two big competitors, the hardware market. Bunnings has it all to itself. If you look at the profit share of industry, it's overwhelmingly Bunnings, and almost in every other competitive industry, you have at least two competitors fighting it out. So I think there was room for Masters, but management wasn't able to sit there and take the early losses required, because of course, anytime a new competitor enters and fights a legacy player, there's going to be a bit of a price war. There's going to be a war for people, a war for property, and that's exactly what happened. And I think a lot of those losses can be attributed to that. I'm sure they probably made some errors, but I do think if they had stuck through the strategy, that they were big enough, they had the financial power, they just didn't have the willpower. And if they had done that, I think Woolies would be better for it today, because I think there's plenty.
I might take the opposite end of that argument. I would say that if you're launching a new chain and it's based on volume, which is what the supermarket's business model is, you have to launch with a reasonable number of stores in order to get the volume discounts on your pricing. Otherwise, you're not going to be competitive with the incumbent. But to do that, you've got to go out and find 50, 100, 150 sites to put your massive, great, big box retailing unit on it. And Bunnings just got there first. So the slow expansion sort of destroys the economics of the operation in the first place. But a rapid expansion compels you to buy sites that probably, or rent sites that probably aren't ideal. That I think that it might have been that balance that they failed to strike, and they just thought, this is too difficult, let's get out. That would be the opposing argument. I'm not saying it's right, but I think that would be the opposing argument.
I'd like to see them. I would have liked to see them learn, adapt, and change a bit more as well. I think they didn't get it right the first time, and their instinct was to panic and sell out immediately. And part of that was investors' fault. Investors were punishing the share price, and really, that's what the management was responding to was falling share price at the time.
Yeah, yeah. I think the short-term mentality in marketplaces
Very short-term
of investors really does punish businesses who are taking big bets like this.
Yep.
Yeah, and they did respond. They just responded in the wrong half of the business, I would say, because they then kind of had lost so much on Bunnings. They'd kind of dropped the ball with their main grocery business by all of this distraction for 5 years. Aldi had just come in and had now had a like 9% market share or so. That was putting pressure on prices, and Woolworths essentially had to drop prices pretty quickly and change their business model to this everyday low pricing strategy instead of just relying on kind of promotions and high margin products the rest of the time. And yeah, I think that's what really killed it over the past 10 years is Masters blew up a bunch of money up front, but then since then it's had to just double down on its grocery business by lowering prices to keep up with Aldi and particularly Coles, which has done very well over the last decade at kind of chipping away at its market share.
Graham, do you think there's an argument that Woolies sort of sat there as the dominant firm and probably over-earned for a long time? Because I remember sitting in the office and looking at those margins. At one stage, Woolies was earning 7% EBIT margins. It was the most profitable grocer in the world by some margin. I remember comparing them to Carrefour's and some of the UK businesses, and they were earning sort of 3 to 4% EBIT margins, and these guys were earning sort of 7%. So, and that's come all the way down now. So I think you can also run a case that they used years of dominance over Coles just to instead of getting more competitive, just sort of eating extra profit.
Yeah, I mean, I agree with that to some extent, but also it hasn't been Woolworths losing market share to Aldi. Woolworths and Coles have been pretty much head-to-head for ages, and Woolworths is still the larger of the two with the 36.
Hang on. Let's make sure I got this correct. So before Coles got taken out by Wesfarmers, they were a complete basket case. And I think they had ceded a lot of market share, and they were barely profitable at that point too. It was really Wesfarmers who sort of turned the corner. And I think in those years when Coles was not competitive, that's when Bunnings. I'm getting these too many companies.
All these retailers.
All these retailers. That's when Woolies should have probably that they could have just turned the screw a little bit, but they collected extra margin. I saw Telstra do the same thing when Vodafone had its big Vodafail moment, and that business looked really imperiled. I always thought the mistake Telstra made was not squeezing Vodafone out of the market. They should have actually just maintained margin and just taken so much business away from Vodafone that they would have probably been forced to exit. But instead, they raised prices and their returns actually skyrocketed and gave a little bit of breathing room to Vodafone to sort of discount their way out of it.
Can you imagine the government Royal Commission if Woolworths now had a monopoly?
Yeah, you're right. That's true. Maybe that's not a realistic option. Yeah, it's a good point.
So, Graham, how did Woolies turn it around?
Well, they turned it around by adapting their strategy on their grocery business. So they basically accepted that the days of large discounts and irregularly kind of bringing in shoppers with different catalog discounts isn't going to work against Aldi, and Coles had already started shifting its strategy to an everyday low price kind of model. Woolworths then made a pretty abrupt shift to that in 2017 or so, and basically lowered prices on a lot of items. So it went from a 7% operating margin down to about 5%, and it stayed there ever since then. That kind of stemmed the market share losses, and since then it's been much more stable, I think, than it's kind of than it looks. And for all of the talk of COVID, during COVID, it kind of earning ridiculous returns. I don't think that actually plays out. Even the margin through COVID was a little bit lower than it is now, and
okay,
you can say it was over earning in the kind of 2009 to 2015 mark, but today I think it's much more in a sustainable position for margins.
How do you think delivery is going to change the competitive dynamic between the two of them. I mean, from my observation, I might be wrong about this. You know better than I do. Coles seems to be a fair bit behind Woolies in terms of the online ordering. Would that be correct, or was that?
Yeah, that is true. And I think Woolworths does better with the click and collect, which is a higher margin
Right.
offering than just straight delivery. So I think Woolworths is doing a pretty good job online, but it's still a sideshow to the main grocery business.
Okay.
So it's on the buy list, Graham. What kind of returns do you think investors can expect from here?
Well, it's starting off with a 5.5% free cash flow yield, and if it can just earn even if it can just keep up with inflation and population growth, maybe keep rolling out a few stores as new suburbs pop up, then I think a 10% return is not crazy from here. High digits for sure, so high single digits for sure, and yeah, that might be enough for a lot of investors who are looking for it's got to be one of Australia's best retailers. It is not going anywhere, and it's still earning pretty good returns on capital. And
yeah,
I think it's going to be around 50 years from now.
This isn't going to excite the crypto investors of the world or people who bought Pro Medicus at $150, but this is the point. This is the kind of place where you can put some money, which you might otherwise put in cash or term deposit or something, and get reasonable returns at reasonably low risk while you wait for the excitement in the market to subside, if and when that happens. It's not a bad parking spot. It's quite a nice idea in that respect, as long as you see it in those terms. This is not an exciting stock. This is a boring stock with a reliable yield, and it's going to be here for a very long time, and the price is not expensive, which you can't say that about many stocks these days.
Yeah, exactly.
Okay, let's move along to BHP. Now, Gaurav, I have to say, what is it, 2025? I would say 20 years ago, BHP was one of the great market indicators of where we were in the resource cycle. If it made a big acquisition, then you knew that you were probably near the top of that particular resource. It didn't matter what it was, whether it was nickel or copper or shale. They managed to pick the top with unbelievable accuracy and regularity. Is that a fair assessment?
Oh, my word, yes. There's an old saying in the industry: if you want to get rich, buy something to BHP or sell something to BHP. Just transact with them. They'll be on the losing side of the transaction.
Yeah.
And I still think that's a reasonable, that's still not completely wrong.
Really? Yeah. I thought the company had transformed.
Yeah, no.
It became the safe, conservative player while Rio went off and did all sorts of silly stuff. BHP was just generating a nice, became a dividend stock, didn't it?
Yeah, no, there's truth to that. You're right. I mean, I'm being a bit facetious. Yeah, you're right. BHP is no longer the BHP it used to be, the BHP which you chuckle about after mentioning its name. That's certainly not the case anymore. And the big change really came, I think, there was that really large commodities boom. We call it the great commodities boom, sort of between 2003 all the way to 2015. Mm-hmm. And people refer to that as a super cycle sometimes. During that cycle, the price of iron ore went from about $20 to $30 a ton, which it had traded for the previous 30 years. And it suddenly changed to about $100 a ton, which it has been trading for the last 15 years or so. And there was a real step change, all because of China. Yep. And that's what really, that got the excitement going about BHP. That's why there was such a huge boom. And then all the other commodity sort of followed after that. But we got to the end of that cycle in 2015, and BHP had nothing to show for the greatest resources boom in history. And I think there was a lot of impact because of that. Shareholders are really cross. There were board changes, management changes, and there were new demands on BHP that hadn't really been made before. I think we'd all gotten used to this idea that it was okay for BHP to make money in booms and lose it all in the other part of the cycle.
That's what the resource cycle was, wasn't it? That's what right. It used to be. You'd expect all the people inside the business to blow money at the top and then, make it all back when prices fell and they started, they cut costs and closed unprofitable projects and became profitable again.
Well, that wasn't acceptable anymore. It changed, and it changed because investors demanded it changed. And to the credit of BHP, they really took that on board. And you can sort of, if you go through and read some of the reports from the period, the annual reports, you can see almost before your very eyes the transformation of the organization, the humility and the recognition that they'd really stuffed up the last 10 years. And everything changed. So the big change came from the structure of the business. So they spun off a whole bunch of assets. They basically undid the merger with Billiton that had happened during the boom years. Yeah. And they had slimmed down all their commodity portfolios into four main commodity groups, sorry.
Yeah.
And then they adopted this capital allocation framework, which I think a lot of people viewed with skepticism at the time. But BHP has been remarkably disciplined in adhering to that framework, and they've been consistent in following it. And then the framework sort of tells investors that BHP will look after its assets first, and then it will pay dividends after that. And it has enforced a high hurdle rate for incremental investment. And that means it doesn't no longer blows money on capital expenditures, and the growth projects that it does pursue appear to be higher quality and more thoughtful than they have been in the past. And we haven't seen any big silly acquisitions. We have seen a couple of acquisitions, but I'd argue that those have been pretty sensible. And even the tilt at Anglo American, I thought was well thought out. And in the article I wrote on BHP, I sort of went through the last three acquisitions and said, look, these are actually really good deals. And I'm not sure the market has quite understood the impact of the last acquisition. They did they carved up a large copper deposit in South America with another business. And I think in the years ahead, that will be a landmark deal. It's actually, it's going to be a driver of earnings for decades to come.
That's Philo, is it?
That's Philo, yeah. Not well known by Australian investors, but just a phenomenal asset. And I think BHP and Lundin, its joint venture partner, have the right idea about developing that. They're really taking a long-term approach and not just getting it into production as quickly as possible. They're really turning it into what we call a basin. It should have sort of 100 years of resources and be another Escondida style operation.
So the way that you might evaluate the latest acquisitions, which is Oz Minerals for 8.4 billion and half share in Philo, is to look at the projects themselves and say, do these projects stack up on their own terms, rather than
do they fit into the existing portfolio?
Right. Okay.
Yeah, I mean, in the past, what BHP did, I mean, take shale, for example, right? I mean, BHP had an oil business, but shale is a completely different thing technically. In a new geography, it was a very different business. And BHP ran into that blind and giddy with optimism because that was the hot thing. Ditto with when they bought the Western Corporation. What was it called? When they bought Olympic Dam.
Yeah.
They bought that again with very little knowledge. It didn't fit into their portfolio really. They just bought that because it was the hot commodity at the time. And that was the way BHP used to do things. They should chase the fads. Yeah. And I think what they're doing now is just they have a strategy and they're adding assets which fit into their strategy and which actually make the existing assets even better. It's new. We haven't seen this kind of behavior from the business before. It's kind of wild to see it now. But I've been quietly impressed with BHP. I think this is a legitimately reformed business, and it's not just a cyclical thing. I think there's been a structural change in BHP.
So you think this is something deeper in the culture that's changed, or is it just Mike Henry has kind of come in and led this charge, and once he goes, it'll all go back to the old days?
No, I'm going to say it, Graham. It is different this time. No, I think the business has permanently changed. We've seen now through several CEOs that they've been able to hang on to this more disciplined capital allocation framework. So I think this is a more permanent change. And I think actually Rio is now looking at what BHP has done, and they've had a something of a lost 5 years, half decade themselves. And I think you're going to start seeing some improvements in Rio Tinto as well. Interestingly enough, the change that's happened to these big miners is now being translated into gold companies as well. I mean, no one has been more scathing of gold miners than me, I think. And I've just noticed that they're just behaving a little bit better than they have in previous cycles. And I just wonder.
It's kind of disappointing. Like
it is.
I like the wild west of the gold sector. You know, all the Spears and Shonks and optimistic geologists who wade into it. It would be a shame if it became BHP.
I'm sure that's all still going to be there, but at the big end of town, they are behaving so far anyway. We'll have to see. It's early days in this gold bull market, but so far the behavior has been more disciplined than I had thought. And the language that the big gold miners are using mimics the sort of language that BHP was using during its transition. And I think the lesson, so BHP, it probably gets rewarded now with less cyclicality and a more stable valuation, whereas gold miners fluctuate wildly. And I think the rewards of better capital allocation are not lost on those management teams, and that's probably what's driving the change.
Yeah. So back to BHP then. It sounds as though you're quite enthusiastic about this company. What kind of price would you upgrade it? It's currently a hold at about $40, I think.
Yeah.
You feel as though that's a reasonable. What would the buy price be?
Yeah. Look, I always think with BHP, it's the sort of thing you should just hold in your portfolio for most of the time, and once every 10 years or so, you get a chance to buy it. And equally, you might get a chance to sell it. Now, we came awfully close to selling BHP at 50. In hindsight, probably should have done so. Yeah. Didn't do it for portfolio reasons. But you want to transact this business in times of extreme optimism or extreme panic. You don't get opportunities really with BHP. It's very efficiently priced. It's a low cost producer in everything, so it doesn't really lose money over the course of the cycle. So you really need something. You need something external to come and shake the share price up a little bit to create the opportunity. And you know, it's similar to Woolies in a way, because the share price doesn't do very much. You only really you only make money out of the stock if you buy it particularly cheap, which we have actually done in the past. But it's getting harder to do so. So I'm an advocate.
It was easier to buy it cheaper and sell it more expensively, though, when it was more cyclical and was doing stupid things along with the cycle. It was easier.
This is the great
spot.
irony, John. I reckon we actually could have made more money out of BHP if they had followed their old ways. But now that it's been reformed, grown up, it's harder to make money out of it.
Yeah, that's true. That's true, isn't it? That is true.
So my advice is to, I think this is a business most investors can hold and ought to hold. But you really want to only transact in moments of extreme action. And that's not now. So, you know, we're not miles away, but I don't think this is the point of the cycle to be buying or selling it.
And just to emphasise that point, the only fund in which we own BHP is the Australian Equity Income Fund, which tells you all you need to know about.
Which is incredible,
BHP's
isn't it? It's
changing
wild.
nature. Yeah, it's a wild thing. I wouldn't have believed that 20 years ago, and yet here we are. Okay, that's BHP. One to watch. A very different company from what most people used to see it as, and maybe haven't really updated their mental models of what BHP is like, but it's doing interesting stuff. It's got a great portfolio of assets, and below $30 we would like to put it back on the buy list. That's it, gentlemen. I will say goodbye. Graham, you can go off and have another whiskey, your little nightcap before you head off to bed. Gaurav, you can go and eat your carrots. I'm going to go and make a coffee. Thank you to our producer, Greg, and we will be back with you in 2 weeks' time for reporting season. Speak to you then.